All right, that's better. Now I am all ready to go. So we will do first up. So week 1. So I'm going, okay, few rules. I'm not going to pick, I'm not picking any ETFs, mutual funds, any of that. So these are direct stonks. I'm not doing any monthly paying stocks. These are strictly quarterly paying stocks. So we're talking about 12 weeks. You can't do every week, right? It's 52 weeks, but basically a 4-week calendar per month. So we're picking just stocks. We're not doing ETFs. I'm not doing BDCs or any of that jazz. Nothing fancy. So 12 companies to rule them all. All right. So write that down. Okay. So the first week of January. So remember, pay date, not ex-dividend date. So our contenders are ADP, Hartford, and Lamb Research. So they all pay that week. Okay. So I'm not going to show the stats on all of them. I mean, I think this video would take forever if I did that. So we got ADP. We'll just show the contenders. I think you all know ADP, payroll company, biggest in the biz. Payout ratio is under 60%. So a company this large, great. Double-digit dividend growth. Their projected growth is still good. So good. Okay. I'm going to try and breeze through this. I'm not going to cover every single one. All right. Hartford. I like low payout ratio, still double-digit dividend growth. Solid company. Insurance has, there can be some problems in the future with insurance. People are getting older in America, which would be concerning. Weather impacts, they're going to have to pay out more potentially for earthquakes, hurricanes, volcanoes. Who knows what happens? So we will see. All right. And the final contender would be Lamb Research for the first week. Lamb Research, quite a run this year. Very impressive. So you're selling equipment in a fast-growing computer industry, so appealing growth in the future. The dividend is under the SPY, which is kind of a bummer. Payout ratio, really low, potential to grow. Tech companies, though, you don't know how far they're going to raise the payout ratio because they have a lot of CapEx on equipment. So those are the considerations. So the winner is ADP. So ADP is taking week 1 of that. I like ADP's got a strong case for growth. Their payout ratio is responsibly run, good growth. So takes the cake. All right. Next one. Week 2 of January. We've got Merck. Merck, my bird. All right. We got Merck. I'll throw one in here. This is a tough one. This is a week 2 January. That calendar's tough. Eastman Chemical. And then we got the big boy that week is Altria and Philip Morris. They both pay like the same day. So basically, Merck is a slow-growing giant pharmaceutical company in America. If you look at their growth for the last 20 years, kind of meh. How much bigger can a company like that get? Payout ratio is very low, though, for a company that size. It's responsibly run. Their pipeline looks good. They have a lot of exposure to upcoming cancer drugs. Eastman Chemical is a chemical company. Great dividend growth, great yields. There's some potential for getting into recycling in Europe and some other just biodegradable plastics. They could have a good next 10 years. Altria, they have exposure to Budweiser, which used to be actually not a bad thing until recently. They are going to expand, I believe, outside of the U.S. potentially. Different products besides, the non-carcinogenic inhalants of nicotine. So who knows? We'll see what could happen there. So the winner of this is Altria. Surprising. Maybe that surprises some of you. So we are going to go with Altria. You might think, oh, man, what about growth? I'm like, this is not about growth. We're just putting a weekly dividend portfolio together. I wanted at least some high yield in here, and I think it's more appealing dividend. I think the growth will slow down, but it's okay. I think it's an okay for this time period. Okay, so next up, we got the third week. You got Republic Services. That's one contender. Occidental Petroleum. That's another contender for the third week of January. And then we're going to go with Cardinal Health. It's the other one. So very quickly here, I don't know much about Cardinal Health. Its dividend growth rate sucks. Not interested. Occidental Petroleum, interesting growth story potentially. Though they have carbon capture technology. They have really good assets in the Permian Basin. Warren Buffett's in it. There could be some sort of float issue with he's buying stocks, the company's buying stocks back. There's appealing valuation. Republic Services, garbage company, recycling, could be beneficial in the political environment we're in. So I am picking, let's pick which one I want. I think you know where I'm going. Mr. Garbage Man. Yeah, there you go. Great payout ratio. I think it's responsibly run. They have good growth plans in the future. So there you go. There's the third week. Boom, boom. All right, we will finish January and I'll look at comments. Okay, the last week of January, there's honestly like not much to look at. So basically, JP Morgan. I don't know what else you'd place in that. There was like a oil company, EOG. That was the only other one I could find. So JP Morgan, fourth week of January cycle. All right, let's see comments. What up, Dom? Dan man. I had to re-upload my video yesterday. I added more to the back, stuff I forgot to cover. Thoughts on ARK. Why? Why would you do this to me? Stocks only go up, I guess. Company. Yeah, I'm only doing like US stocks. Just well, actually, no, there is an international one in there. This isn't going to cover other stuff. Innovating. Yeah, Altria. I actually don't hate because I think they should respond. They should lower the growth rate, and they're talking about only having the dividend grow now. I think at a lower rate than it had in the past. I can see a path where it's not a bad investment. It's been a great investment for people for 20 years. So it's not. I don't think it's terrible. Team Waste Connections. Yep, that's a good one too. Dividend passive. It's free money, right? No REITs. Nope, no REITs. I'm not getting into that. Not in this. All right. So week 1 of the February cycle. Remember the pay date, not the ex-dividend date. So we got Lowe's. We've got John Deere, Bristol Myers Squibb. So some decent choices. Lowe's did have an appealing valuation, low payout ratio. I think they have some decent growth ahead of them. They have a lot of debt. I think they were buying back shares with debt, which was a problem. Their dividend growth just slowed. The most recent raise, that's concerning. John Deere, I think you all know I like tractors. I think the growth story in tractors is pretty good. John Deere's risks are they're already so large a business. They have to have this technology they're developing work out, and they have unions concern. Bristol Myers. I think Bristol Myers Squibb has maybe the best pipeline of drugs. Not now, but like 5-10 years from now, I think they have of all the big drug companies. They have potentially the best pipeline. So given all that, I will pick John Deere. So we will take John Deere. Although if someone said Bristol Myers, I wouldn't hate it. Or actually, I like all three, but I'll pick John Deere for this. Okay. So we got next up. Next up is the second week of February. A lot of choices in this one. A lot of choices. Okay. Texas Instrument. You have Salance, whatever, CE, Carrier, Morgan Stanley, and Air Product Chemicals and British Tobacco. So you got lots of choices in that second week cycle of February and February, May, November, August. So Texas Instrument is, I call this like an OG dividend or stock or dividend stock. I mean, again, payout ratio for such a large company, very well done. You're getting good growth. They have fabs that are coming online in the US. So the onshoring is going to benefit Texas Instrument potentially. High margins compared to a lot of other chip companies in their space. So very appealing. I've had it for a long time. CE, I wish I could say their name. I'm a clown. Yeah. Buffett owned it, although I know he did drop his holdings on it. Some interesting fabric or chemical developments. You'd like the Buffett ownership's he dropped a big chunk of it. Payout ratio is low, some growth. Kind of meh, honestly. Carrier, I think I've talked about Carrier. I love Carrier. I think there's bright lights ahead of them. They're going to do well, but the dividend is pretty low. So for this exercise, I don't know. Morgan Stanley. this one, it seems kind of high evaluation at this point. And I would be concerned if they would actually keep the dividend, because it's not really apparent they are a dividend company. It's kind of iffy. They've raised it and lowered it. It's changed over time. So that, I don't know if I would add that one. Air Products and Chemicals, if you believe in hydrogen technology, like they're building hydrogen production in America. So if you think we're going to fuel cells, this could be appealing. They've been a really good dividend growth company. Problem, their free cash flow compared to their dividend payouts is a little concerning at this point. So I don't know if I would do this one. In this same week, you have British Tobacco, which a lot of people think is an appealing investment at this point. Since I already picked Altria, I'm not going to consider this one because I already have Altria in this basket. So we're not going to do two. So the winner is the big boy, Texas Instrument. I think they have the most appealing case, good dividend, good growth. I think this would be a good one to add here. Okay. Let's see. Week 3 of February. It's Caterpillar, Abbott Labs, AbbVie. Abbott Labs dividend rate is really low, but I like their prospects. AbbVie is kind of in a weird place right now with their patents. You know, what's the future? So, and they have a high debt ratio. I know they're paying it down. So let's make this easy. It's Caterpillar. I don't know why you wouldn't pick Caterpillar in this spot. It's one of the best dividend stocks you could probably own long term. Look at that payout ratio. Like, that's incredible. 30%. Not, I mean, you're getting almost double-digit growth rate on the dividend. You buy it, you know, from time to time. So there you go. All right, any more comments? Let's see the comments. I'm trying to get through this faster. Mid-single digit dividend growth through 2028. Okay. Yeah. And I know they said specifically they were going to they told investors to expect the growth of it to slow down. I can see them becoming almost like a holding company where they're making investments in other businesses instead of developing new products in the tobacco space. I mean, it's not a bad plan for investors. How long can they sustain that? But I mean, depends on how long you would expect to hold it. Like 10, 20 years, it's possible. KRC, no REITs. John Deere, yeah. Pfizer got some fat drugs in phase 2. I don't know. I'm not a fan of Pfizer. I mean, if you were like some millionaire, you just wanted to stash money away in something, I mean, I guess it's not a bad idea. See, slow dividend growth, no buybacks until they buy it. Yeah. Yeah. I don't think the story with C is that appealing. I had a lot of industrials here, so I had to pull it. Yeah. Mm-hmm. Yeah, like I said, though, I mean, since I had to pick Altria in that other spot, I didn't want to do too much, although it is an appealing investment. I like it. I'm dead. You wanted weekly dividends, you were going to get weekly dividends. That's what we're here for. All right. So the last week of February, okay, who's writing this down? Someone writing this down? This is serious. You got Starbucks and Charles Schwab. That's your choices. The February, May, August. So you got Schwab and Starbucks. Only S's will be considered in this last week. My only concern with Charles Schwab, I'm just like, they were damaged by what happened with the regional banks, and also they're not the same company that was there during COVID. A lot of the cash has been pulled out, put in other things because of the interest rates, the regional bank crisis, whatever you want to say. They did, though, get inflows also at the same time. So it's like, how do they balance out in the future? I don't think it's the same company as 2 years ago. So if you're going to look at their chart and say that they could get back to those highs, I don't know. I would be concerned. Starbucks, you have to believe in their growth plans in China. Otherwise, I don't know why you'd buy Starbucks. You have to believe they're going to rapidly grow in China. That's their plan. If you don't believe that, then I don't know. So they're both concerning to some degree. Don't have a lot of choices at this point. So I'm going to pick Starbucks. So I think there's a better chance that they'll do better. I don't know, for dividends, right? All right. So now we're in the final month. This is the hard one because there's so many choices in March, June, September, December. It's where the vast majority of dividend companies pay. We've got all sorts of choices. So the first week of March, we've got Kroger. We've got KLAC. Let me put that one up here. Symbols. You got KLAC, Kroger, ConocoPhillips pays this one. Also, they pay special dividends outside of this cycle, and Johnson and Johnson. So I bet you. So let's see, Kroger. You've got the merger problems, right? Will the merger go through? It's looking like no at this point. And how much bigger can Kroger get? They're already one of the largest grocery companies in the country, so they're going to have to start buying out other companies, which could be concerning because M&A is not a great thing for a dividend company necessarily. KLAC, they sell equipment to like every company that makes chips in the world, basically. Huge potential growth. I think I've talked about it enough. ConocoPhillips, exploratory drilling. So obviously that's your exposure to oil with that one. They've had assets get seized by Venezuela in the past, so they're all over the world. So you get currency risk, you get, political risks with them just by where they operate, all sorts of stuff. But they do pay a pretty low payout ratio. Let's see, Johnson Johnson spun off Kenvu, so you think they'd be a more higher margin company, consistent dividend growth. They're like one of the best in the world at that. So I bet you all think I'm going to pick Johnson & Johnson. So here's Conoco. Yeah, it's not bad. So they could weather like a bad period of time, I think, and it would be okay. But it's exposure to oil. So I would pick KLAC. So since I've got a high yielder with Altria, I'm going to pick this one. Here's the big boy. I think this company's got great runways ahead of them. And the yield is low, but I think they just got runway ahead of them. It's tough though. I could see Johnson & Johnson or them, I think, are really appealing in this spot. But I have to pick a winner, right? So there you go. So KLAC. All right, we got 3 to go. Next one. Second week cycle of March. So you got Analog Devices, Tractor Supply, love it. You got Microsoft and Chevron. So there's some big ones. So right off the bat, though, I'm going to throw Analog Devices out because I already picked Texas Instrument, so we're not going to double up. Surprisingly, I'm going to throw Tractor Supply out, which might kill some. I know I love them, but in this spot, I'm going to throw them out. I already have Starbucks. So I'm going to pick, because I don't have any tech in this thing, I'm going to pick Microsoft. Let's just make it. I don't think I need to go over Microsoft and why you would pick Microsoft. The growth projections, the dividend increases. It's going to be an amazing company for a long time. All right. So 2 to go. So we got the third week cycle of March. You've got Waste Management, and you've got Northrop Grumman, Lockheed Martin, and McDonald's. So my thought was McDonald's, I don't know if I would buy them. I'm concerned about their franchise system and how that's going to work out in the foreseeable future. It's very expensive. You could argue their best days are behind them. Waste Management, I already have Republic Services, so we're going to throw out Waste Management because I already have a garbage company. So now we're down to a military company because I don't have any in this. So you've got Lockheed Martin versus Northrop Grumman. I own both. So Lockheed Martin, you have basically they're the dominant player in air power around the world. It used to be just like in America, but now they're selling to Canada. They're selling to everyone. You could see like the future where like every NATO country just runs Lockheed Martin fighters. The F-35 program, they're in the running. There's the 6th gen program that's just being developed. They're in the, obviously they're the favorite to win that. The risk could be that another company wins the 6th generation fighter contracts, and then Lockheed Martin would lose that stranglehold on air assets. The valuation's okay right now. See, payout ratio, I mean, they've always been so responsible, like Texas Instrument, like some of the Johnson Johnson, they just manage their cash so well. These top like dividend performing companies. That's why everyone knows about them. Like they're just very responsible with their growth and their free cash flow. Then there's the other one, Northrop Grumman. Northrop Grumman has all the technology, and they're in all the places you want to be with military spending, space, electronic warfare. They work with SpaceX on rocket. They're probably going to help build the rockets to go to Mars. Telescopes. They help build. It wasn't the Hubble. It was one of the more recent telescopes. So they help with all the space technology. Space and air spending is growing with the defense contractors more than the like ground assets. So choices, right? I think either one's an appealing possibility. I'm going to pick Northrop Grumman. So that's fitting that spot, Northrop Grumman. So we're going to pick that one. All right, last pick. If someone does this, I'm going to laugh. But this is, you could do, I mean, it is semi, you could semi do it, a weekly paying dividend portfolio. All right, last week of March. So we're not picking the ETF, because obviously I'd pick an ETF in this spot because most of them pay this week, the last week of March, June, September. So I would pick an ETF, but we're not doing that because that'd break my rules. Okay, choices. Tran Technologies. Tran does all the cooling. They're basically the king of like cooling technologies, like your the freezers at a McDonald's or a truck with a refrigeration system or trains. They dominate that space. All right. So more efficient, the more efficient that the cooling systems have to be, the smaller players are going to have tough time spending the capex to keep up with the government standards of being more efficient. So you could see a case where could be very good growth prospects for Tran. Cigna, I mean, I've talked about Cigna enough on this channel. I think there's the growth, the dividends increases, the stock share buybacks, and the valuation based on even low growth. So they don't even have to grow that fast for the valuation. Medicare spending, healthcare spending keeps going up. Your risks are the government cracks down on healthcare spending to try and balance the budget more. Prescription drug pricing, where they can negotiate prices, stuff like that. So who else? Broadcom. I think y'all know what Broadcom is. You got cell phones. They're going to try and buy VMware, get into software. So they're going to become more of a conglomerate type software or tech firm, let's call it. I don't know how you couldn't like their dividend stats. They've been one of the best dividend holds probably the last 10 years. Look at that. That is unbelievable. The growth rate. You could argue their best days of dividend growth are behind them, I guess, but they still have such a low payout ratio, and I think they have great growth prospects. And then the last one I would look at, Union Pacific. I mean, trains. I've never bought trains, but I can see they have a stranglehold on, logistics in America. Your big concern would be if onshoring, and you have onshoring in America, which is good, but then what if hydrogen cell trucks maybe become very cost effective? And that would take some of the traffic away from trains, and they have to take on stuff that the trucks don't want to, like hazardous materials, which could then increase the risk of like train accidents going wrong and lawsuits. I don't know, but it's trains. I mean, they'll be here forever. So I am going to pick. This is tough. There's a lot of good ones this week. I like all four of these, honestly. So, but I got to pick one. I will pick Cigna. All right, because I don't have any. I didn't pick Johnson & Johnson, so I'll pick Cigna here. So I'll have some healthcare. All right. So we will show you the results. So here you go. I put it in this. So here they all are. So let's go to payout calendar. So here you go. Look at that. Every week. See the blue ones? That's all the dividends. All right. Close enough. You know what? The days shift here and there, right? It's not the same day every month. Sue me. All right, we're close enough. There you go. I mean, I have done well for you people. You can respond. Do this instead of the SoFi weekly dividend ETF. There you go. So, all right, what are we? 25 minutes? Holy shit. All right, comments. What do we got here? Yep, I know. I mean, if you told me to pick 2 per week, if I was going to do this, I would pick probably 24. So I would do two per week, because there's some real strong ones that I got thrown out. Like if I was to do this, yeah. So I do 2 per week, not 1. I mean, you can look it up. I mean, there's going to be trouble ahead with the franchise system McDonald's has created. I think about it. I don't know. I don't want to get into it here, but yeah, responsible dividend diversification. That's what we're here for. So you can compare my weekly dividend to anybody's. I challenge you, find a better 12 dividend stock. They have to meet that criteria though. You got to try and hit every week. 10-cent pays in May. Yeah, I didn't have time to look at foreign companies. I kind of had to throw this together. Very nice. So diversification. Let's see how. I don't know how I did. Let's see how I did. Okay. Let's see. Can I see it? Why is it so okay? Industrials, oof. Yeah, see, I would want to do 2 per week because I'd need to get my industrial exposure down from this. Um, Technology, okay, 30%. I like it. That's not bad. 10% almost healthcare, financial. I mean, yeah. If I could do 24, I think I could make this actually not a bad portfolio if someone really wanted to do weekly dividends. I could make it more balanced. Um, so with that said, hope you've enjoyed. Good morning, Dan. It's noon. It's like 1 o'clock, Fuhat. What you doing here? Well, I don't know what time zone you are. So with that said, thank you very much, and we will see you later. All right, bye.